Hi, everyone, and welcome to the Steady Investing. This is the Buy Broad, Buy Cheap, Stay Safe, Stay in the Game channel. Let me tell you what that means. We don't belong to one sector. We don't chase one trend. We look at the entire investment universe, hundreds of ETFs across every market, every asset class, every corner of the global economy. And when prices pull back, we move in. Small, calculated, diversified. We buy broad, we buy cheap. We never go all in. And we always keep capital for the next opportunity. This channel is not for people dreaming of getting rich overnight. This is for people who have worked hard for their money and refuse to lose it to inflation, to market swings, to forces beyond their control. If you have a regular income or savings you're afraid of losing, if you're building something slowly and carefully, if you want your money to work without gambling it, you're in the right place. Over 25 years of trading experience, futures, equities, global markets, I've tested strategies the hard way. What you'll see here is the result of that. Not theory, not hype. Practical, safe, step-by-step investing through ETFs. Why ETFs? We'll get into that. But the short answer is nothing gives you more diversification, more transparency, and more control at lower cost. That's what this channel is about. Before we dive in, let me show you something. I built this specifically for the channel, and once you get it, you'll read every ETF in like seconds. Genuinely. It's called the Drawdown and Recovery Analysis. 2 types of bars. That's literally all it is. Red bar is on the left, drawdown, how far the current price has fallen from its most recent peak. Blue bar is on the right, recovery, how far the current price has climbed from its most recent low. Now here's the key. Here's the part that trips people up at first, but once it clicks, it really clicks. A value only appears in the time frame where a new peak or a new low was actually made. So if the 1-week window shows a red bar, that means the most recent peak happened within the last week. And because that same peak is also the peak for 1 month, 3 months, and beyond, those longer time frames share the same reference point. So they go to 0 and disappear. No duplication, no clutter. Empty bars don't mean nothing happened. They mean the move belongs to a different window, already captured somewhere else on the chart. It's already accounted for. So at a glance, where are the red bars? That tells you how fresh the selling is. Where are the blue bars? That tells you how far we've come off the lows and over what time frame. Red tells you where the pain is. Blue tells you where the strength is. That's it. Simple as that. Let's look at today's ETF. One important note before we go further. The percentages you see in this chart, they reflect the closing values of March 18th, 2026, yesterday's close. Today, gold and silver are seeing significant additional declines, like on top of what's already shown here. So whatever moves happen today and in the coming days, those need to be added on top of what you're seeing in this chart. The chart is already behind. So when you're thinking about any potential entry, always factor in where the price is right now, not where it was at yesterday's close. That number is already old. The chart gives you the framework. Current price gives you the reality. Okay, the ETFs.
GLD, GLDM, IAU.
Drawdown from peak, minus 10%. Okay, so these 3 are essentially the same asset. Physical gold, just 3 different packages. GLD, 0.40% cost, deepest options market. IAU, 0.25%, good liquidity. GLDM, 0.10%, lowest cost, lowest share price. Performance is nearly identical because they hold the same thing. The choice between them is really about cost and platform. This is educational context only, not financial advice. But for those thinking about physical gold, the disciplined approach is staged accumulation, not one entry, many entries at different price levels, each very small. Starting at no more than 5 parts per thousand of total portfolio per entry, up to 20 separate entries over time, and only if price continues to fall, never at the same level twice. Total physical gold exposure, all 3 ETFs combined, consider keeping it under 0.5% until a floor is established. The floor can always find a new floor. GDX, VanEck Gold Miners, drawdown from peak, minus 23.94%. GDXJ, VanEck Junior Gold Miners, drawdown from peak, minus 25.49%. These 2 move together, but they are not the same, and that distinction matters. GDX, the majors, Newmont, Barrick, Agnico Eagle, stronger balance sheets, dividends, hedging programs, more defensive within the miner space. GDXJ, the juniors, smaller producers, explorers, thinner margins. And the GDXJ chart tells it clearly from $70 in July up to $157 at the peak. Both still show positive one-year returns. The bull market move hasn't been erased. That's important. But miners carry a layer of risk that physical gold just doesn't. Operational costs, management decisions, geopolitical exposure at the mine level, more potential upside and more downside. Educational context only. GDX for steadier exposure, GDXJ if you believe in the junior cycle and you can tolerate deeper swings. In both cases, staged entries only. No more than 5 parts per thousand per entry, multiple entries at declining price levels. Total miner exposure, GDX and GDXJ combined, consider keeping that under 0.5% until gold finds its floor.
SLV.
Drawdown from peak, minus 34.94%. Silver is the most volatile asset in this entire group. And today, down 6.38% today alone. From 120 at the peak to 70 now. That's a 34% drawdown. That's significant. Silver has 2 masters, gold and industry. And right now, both are under pressure. But the supply story is structural. 5 consecutive years of deficit. Solar demand up 143% since 2016. Mine supply cannot be increased quickly. You can't just flip a switch and get more silver out of the ground. The depth of this pullback is notable, but, and this is important, depth alone is not a signal. Silver can go lower. If you're considering exposure here, start smaller than you think is necessary. 5 parts per thousand maximum per entry. Never concentrate. The floor can always go deeper.
COPX.
Drawdown from peak, minus 21.70%. Copper hit an all-time high above $14,500 in January. Now correcting, that's still up nearly 20% over 1 year. Like, that context matters. The structural case for copper is arguably the strongest here. EVs, AI data centers, power grid upgrades, all of it requires massive copper inputs. Demand projected to grow 30% by 2040, and supply simply cannot keep up. Educational context only. Small, patient, staged entries. Same framework as everything else you're seeing today.
REMX. Drawdown from peak, minus 16.02%. SETM. Sprott Critical Materials. Drawdown from peak, minus 19.76%.
REMAX is focused, like specifically focused, rare earth elements. China controls 70 to 80% of processing globally, and that geopolitical floor? That's why REMAX's pullback is shallower than miners or silver. The supply constraint story is providing a floor that the other assets don't have. SETM is broader, 9 critical minerals: uranium, copper, lithium, nickel, rare earths, silver, manganese. More diversified, less binary. Both carry speculative risk. Many of the holdings are early stage or unprofitable. That's just the reality of this space. Educational context only. SETM for broader diversification. REMAX for concentrated rare earth exposure. Very small entries only. 5 parts per thousand maximum per entry across declining price levels. That's the discipline. So, to bring it all together, every ETF you saw today is correcting from historic highs, and the cause, same across all of them. PPI shock, hawkish Fed, oil above 114, stronger dollar, all hitting at the same time. The structural stories haven't changed, and our framework, it stays the same. Buy broad, buy cheap, stay safe, stay in the game. For any ETF in this group, no more than 5 parts per thousand per entry, no more than 20 entries total per position, each at a lower price than the last. This is educational content only, not financial advice. Always verify current data before any decision. Stay steady.